Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by. Hey, welcome back. Today we're going to be looking at the S&P 500, which has been doing absolutely outstanding for the last couple of years compared to its average returns. Do you know what the average returns have been for the S&P 500 over the last 5 years? Any guesses? It turns out, based on the calculations I ran, from 2020 to 2025, about 13%. We're going to be looking at that in a number of different ways, and we're also going to be looking at how you can actually outperform the S&P 500, which has been on a wild ride over the last 2 years, about 24-25% per year. So it has really been doing great, and yet, using modern portfolio theory, we can actually outperform it. Now, I will get into all that, but here's some things you're going to... Now, here on the graph, you can see we can compare it to the S&P 500, which, like I said, has been absolutely on a tear. Up 50, over 50%, 55, maybe pushing 60% on this graph, which is really incredible. You'll see that it doesn't usually perform that well. That over the last 2 years is something like a 24 or 25% return. So what you can just do, if you want to do the math on that, is just take the square root of like 1.55 or 1.66 or 1.60. It'll give you something back like 1.25, which means you basically had a 25% growth rate 2 years in a row. So we're here more at 25% or 22.90. So just graphically, you can see that less volatility, which is basically I built this portfolio with a lot less volatility intentionally than an all equity strategy. Equity, stock, this is the same terms, same meaning with different terms. So different than the S&P 500, which is companies that are in the United States, housed in the United States. And they're all large cap, meaning that they're all large companies. So this is no startup companies. These are not, there's no exposure to mid cap, we call them, or small cap, smaller middle-sized companies. These are all large cap, large United States companies. Okay, so I've explained modern portfolio theory in the past. You can go and look this up in Investopedia. But basically what you're doing is you're plotting the return and the standard deviation profiles of a bunch of different assets, and you're essentially taking the best ones. Okay, so that's what we're doing. And some of this information would not be that easily available. I don't expect you guys to be doing most of this work if you're just managing your own money but don't like spending a lot of time in Excel. This video will be kind of Excel heavy. Okay, so if you end up buying the quarterly Excel sheet from Patreon, or if you do our full course, you'll end up with something like this. This is actually the most recent file that we put for Q1 2025 on Patreon. It sells for like $30. If you want to become a monthly member for Patreon, you can get them all for, I think it's $5 a month for Patreon. Or we have a full course and you can learn how to add additional assets than what I'm using here. Here's what I'm using. Basically, I'm using these tickers. They're all ETFs, meaning exchange traded funds, meaning that they're like diversified pool or bundle of companies that are all based around a theme. So XLU is utilities, VGT is information technology or tech. You have ones on energy, financials, healthcare, real estate, gold. Here's the SPY. This is the S&P 500. So I always put that in there to make sure. VTI is it's like SPY, or it's like the S&P 500, only it's bigger. It's thousands of United States companies, big ones, small ones, middle-sized ones. We put Grayscale, Bitcoin. We put a couple different bond funds, and then we have, so these are corporate bond funds, and then we have a couple different, so treasuries, U.S. treasuries, 1 to 3 year, and then TLT is from iShares, pretty popular, which is longer term. Okay, so we have all these ones, and I mean, I can't give away the secret sauce of which ones are selected or which ones aren't. Okay, so here we're going to jump into our Monte Carlo simulation. I had a friend of mine call me and he said, hey, this guy is a great guy. Him and his wife are doing so much good in the community. And he says, look, I have this background in like user experience and app development and websites and graphic design. He says, I've been working in financial services for a while. And he said, I'd like to throw some ideas together to see if we can help people, in the community. Financially is what he was basically saying. And I went down and saw him for a few days, and we had a number of different talks, and we looked at some different things. What I basically found out was a couple things. If you're like subscriber to this channel, you'll know that I've been covering some information on a former hedge fund manager called David Rogers Webb. He really suggests that people should have a heightened awareness of certain systemic risks in the way that stocks and bonds and ETFs, all this stuff that we're talking about here, have like certain systemic vulnerabilities for if there's any problems of liquidity, like systemic liquidity, like there was in 2007, 2008. He has some concerns, and I mean, in some senses, after talking with my friend and doing some journaling, I said, you know what? I would really like to teach people how to start their own businesses, basically own their income streams. So part of the reason I continue to do this work online is for that reason. But I also realized that for a lot of people, that's difficult. Evaluating as like a single business. Okay, let's start even more difficult than that. Starting a brand new business, that's not easy. Investing in someone else's business. Maybe you don't know how to value the cash flows, do the market assessment. Maybe there's a lot of different vulnerabilities. You could do certain business skill things like SWOT analysis, but just suffice it to say, it's not that easy to just go find somebody in your community and say, I'd like to buy an 8% share of your company and be compensated, annually based on, the profits that come in or don't come in, right? So for a lot of people, I realized either A, they're not going to be interested in what David Rogers Webb has to say, or they don't know how else to get like a 10, 12% return, or, and I think this is a big or, for people that don't have a lot of money, like if you only have $7,000, it's really hard to find a significant opportunity, small business, startup, or otherwise, What if you only have $3,000 or $5,000? What if you're just getting started? I think for people like this, the stock market is really, even though David Rogers Webb probably has, in my opinion, highlighted some very real and very significant reasons why eventually people would want to get out of the market, that for people that are, like I mentioned, don't have a lot of other options or don't have a lot of experience, maybe, buying an Excel model from me or doing something safe like buying VTI, which is not really that safe, but just getting started with some basic, simple, just money in a portfolio, maybe that's maybe their best play. So I'm going to continue to do this. So in this, what we're looking at is modern portfolio here, you can see in the green bar, versus the S&P 500. Now, I've always said in my course and in my Excel, files, and that, there are really two different ways of thinking about how modern portfolio theory could work when it comes to risk-free asset. I got to get a little nerdy here, otherwise this is not going to make sense to new people. But if I go back to this picture here, what we are basically doing in modern portfolio theory is we are taking a list of assets like the ones I showed you just a minute ago. Oil, financials, healthcare, utilities, consumer staples, consumer discretionary, maybe Bitcoin, maybe S&P 500, maybe some larger ETF, maybe bond funds, corporate bond funds, junk bond funds, treasury funds, let's just get a nice mix together, and then we'll basically analyze them and lay them out here on a graph like so. Then what you're basically doing in modern portfolio theory is you're saying, hey, what we would like to do is we don't want to just own like one fund. We don't want to be exclusively, say, in utilities. Say like that is utilities or Bitcoin or whatever. If something has a great return, it usually has also a high risk volatility. Like it jumps around a lot. It's on a huge run. It could crash later. You don't know. But over the last 5 years, it's done pretty well, although it's been a real roller coaster of a ride on the way up. That would be like describing these types of things. So the idea is not to leave these like things, leave them out. Don't leave them out. I mean, these things are doing really great. The thing is, you don't want to just hold stuff like that. What you'd like to do is kind of like have a little bit of risky stuff. And if it does great, awesome. It could really pull up your average. But mostly you want to have like the core of your portfolio in something a little bit safer. So when I'm talking safe or risky, I'm talking about this horizontal line here, the standard deviation, the x-axis, okay? And then this vertical piece is the higher, means the higher it is, the more it is returned, okay? Well, essentially what modern portfolio attempts to do is it takes all of these different assets and it says, okay, what I would like to do is find the one that essentially is here in this orange dot, meaning it is, this is going to get a little nerdy here, but it's going to fall somewhere on this outer blue line, and I have a number of different things on this outer blue line, right? But it's basically a curve. And what I would like to do is find the point here, which you can do mathematically with Excel, that intersects or touches this straight white line. What is a straight white line? The straight white line is the U.S. Treasury bond funds. Basically, it is a, we call it the risk-free asset. Essentially, it's a very stable, dependable asset that you can buy to sort of, what you can do is you can dilute down this basically orange dot. You can say, okay, I'll take some orange dot, but I don't want to have that much risk. I don't need that much return. This is 28% return. I don't need that. You know, I'm not trying to like hit crazy home runs and then like just see this thing crash. Bring me down a little bit more into this reasonable level. 10, 12%. Like I said, I'm running the 12% portfolio personally. And my parents, they said, why don't you put us in the 10%? So 10, 12%, right? That's something more reasonable for the average person. If you get a good jump, you know, if you start early or whatever, like just that's essentially the idea. So you put some money in the orange, and then if that's too risky and you don't need that much return and you don't want this like just insane like boom bust cycle in your portfolio, just dilute it with some treasuries. And the more treasuries that you buy and the less of this orange dot you buy, the more you're going to move down this white line, and you can stop wherever you want. That's like the whole idea of modern portfolio theory. Find the best basically basket of this risky stuff, these green dots here, even some of these real crazy ones, and buy a little bit of the crazy ones because they've been freaking killing it, right? But you don't want to be like overly exposed to that. You're not sure what's going to happen. But over 5 years, they've done pretty well. So hopefully they continue to do so. And you can have a couple like, I don't know, ones that really, really do great. And in this way, we're able to basically beat the S&P 500. We're able to, mostly we're beating it on the risk like exposure to it. So I'll go back and show you how that works. And so we're going to be talking about things like standard deviation return, and then the mixture of those two things is something called the Sharpe Ratio. So let's go look at that. Okay, so here I have the basic numbers for what the S&P 500 has done over the last 5 years. We have an annualized return, meaning average year, it gives 13.4%, like I said in the introduction. The risk-free rate that we're using is the U.S. Treasury 20-year bond, 4.79%. And standard deviation, this is a calculated number in purple. I use some of the colors here to just keep my eyes focused. So standard deviation was 16.55. And basically the Sharpe ratio, the combination of those two, essentially, is 0.5. I'll just pull up a little image here from a screenshot I took. This came from, I think, Morningstar. Yeah, Morningstar. So this has a Sharpe ratio of 0.76. The total return, they have it at 14.89, so a little bit higher today. We're in July. I think the numbers that I did the calculations from kicked off or ended off in April. Okay, so the S&P 500 has had like a significant run. And the standard deviation is 16.26. What did I say it was? 16.55. So we're right on there. The difference on the return is just because, yeah, the market has really been up for S&P 500 in basically May, June, and July. Okay, and so that's why we have a little bit higher Sharpe ratio here coming out of Morningstar as well. But basically in the ballpark and generally accurate. Let's compare that to these other assets. Now this I can't, I can show you the output. So if you end up buying this, this quarterly document, there'll be this tab called Dashboard, and basically you will get an expected return and a standard deviation. And so that's listed here as well, and it's really important. So we have a 0.86 Sharpe ratio, which already we know it's better. It's better than the S&P 500 at 0.5. So let's go back to our other screen. But I was just telling you that these are calculated. I can teach you how to do it if you want to take the full course. If not, basically, you can. It will show up in the quarterly Excel files from Patreon. Okay, so 15.51, 12.43. That means we have a 0.86 Sharpe ratio. So I know right off the bat, like this modern portfolio theory for the risky assets is better. Now all I'm doing is diluting this down. So I should be able to maintain a similar Sharpe ratio, but I'm going to, in theory, dilute it down with one of these two. So usually, it just depends who you talk to. When I did the Masters of Finance program, they were talking about a product like BIL, BIL is the ticker, or SHY is the ticker, these U.S. Treasury short-term funds, okay, as basically like guaranteed money. So I guess let's start with this one. I also include TLT because TLT is something that, basically Mark Meldrum mentioned in the CFA. It's a designation for asset managers that a lot of industry and professional portfolio managers use something longer term because it would depend upon the fund manager. But essentially, if you're long only and you know that you are going to be in these assets for like years and years and years and years, like you're mandated by what you said when you crafted your investment statement, that we're long only, we're always going to be in the market, meaning you're always going to be exposed, whether the bonds are up or down. You may lighten up or increase your weights on that, but if you're always going to be in them, you might as well take the ones that pay a little bit better coupon, and so monthly coupon. Well, TLT pays typically a better monthly coupon than some of this shorter duration stuff or shorter term stuff. So anyways, I guess let's just start with the SHY. So it has about a 1% return. All these numbers are, I'm not going to convert them to percentages. They're just, but think of them as percentages. So it basically has a 1% return a year, which is not that great. But the standard deviation in purple is so low, like it's almost zero. It's 0.02. So it has, again, these are already in percentages. So it's not a 1%. It's not a 1% standard deviation. It's not a 0.5%. It's not a 0.1%. It almost doesn't move at all. You basically can lock in a 1% return and no ifs, ands, or buts about it. So there you can see the theory. Here, if we go to the TLT, this is the longer term bond fund, it actually has a pretty high standard deviation, 15.17. Okay. And over the last 5 years, bonds have gotten beaten up as interest rates have risen. And so this has an average return of negative 10.1. So this is the one that I've been running. And, I showed you before that we had still achieved a 10.05% return, even with a huge drag from TLT. So that's pretty awesome, since TLT has been like a net drag or a it is taken away from the total return. Now this is one thing you will learn later in this video, or if you go to graduate school, that when it comes to combining like a 2-asset portfolio, so let's say we take this green one, which is basically all the stocks or the risky assets, and then we're diluting it with one of these 2 gray boxes. That's why I have this little yellow or. Either you're going to put, for me, 66%, because that's just how the weights happen to turn out in my situation for a targeted 12% return. 66% in the risky stuff and 33% in one of the U.S. Treasury bonds. I could have either taken SHY or TLT. I took TLT, and even though it drug down my returns, I still thought that was the better situation long term. So we'll see how that goes. when it comes to combining two assets, so like the green and one of the grays, you cannot combine them in a normal way where like if you just take an average. What I mean is you cannot just take a weighted average on the standard return here, like the 12.43. So I got 66% of my money in this thing that has a standard deviation of 12.43, and I got 33% of my money that has a standard deviation of 12.15. And so I just can't take the simple average like, 12.43 plus 15.17 divided by 2 and come up with like a standard deviation of, what would that be? Like something like 13, high 13s, low 14s, something like that. It doesn't work. So I'll show you here coming up how to actually do that. It's not that difficult. It's really not. More of anything, it's just getting all the numbers that you need to plug into this formula. So again, not something I expect retail or just like a non-finance person to want to learn. I know there's, I have engineering friends that love this stuff, but most of them are too strapped for time with kids and sports and school stuff, and they're just exhausted from engineering and Excel already, so they don't want to do it on the weekend. But generally, I'm just giving that to you as just like a bit of a piece of knowledge, more for people that are planning on going into like asset management, CFA program, master's or bachelor's of finance. Okay, so that's why I have these big red X's here. It's like you cannot come up with the Sharpe ratio by combining these just in a simple fashion. Let's just do some checks on my numbers for TLT. Okay, so here we can see pretty close to my numbers. This is TLT. You can see that here. If we look at the 5-year return, it's down negative 9.18. And what do they give us for the key features, benchmark, funds, portfolio characteristics? 16.25 on the standard deviation. So negative 9 and then 16 something something. And if we click over to SHY, we're looking at a standard deviation of 2.15%. That's the 3-year. Okay. And what should you get for returns? Oh, here we go. 5-year performance, 1.21. So 1.21, we had it at about 1. They're saying the standard deviation is above 2%. We have it way lower than that at like, is this a percent? It's premium discount. Yeah, they have 2.15% on the standard deviation. So different than what we have, certainly. Okay, so here's our bit about Monte Carlo, average Monte Carlo simulation using 500 trials. And so what I basically have is, this is the mean, meaning it's like the average return. And so up here I had, based on my calculations from actual data, 13.4% was the return. And if you run this 500 times and take the average, you'll get about 11.44, although that will change, if we could be 12.46. So there's some, volatility, 12.78, or what else could it be? 12.98. Just depends. It's basically dependent upon a random probability generator. So looking at the average for the green assets in the modern portfolio simulation we ran, 15.51 is what it said, and 15.2. So it's it's basically very close based on 500 iterations and taking the average of those 500, 15.5 compared to 15.5. So it's basically same, or 15.9. Anyways, and then just looking at the same averages for TLT, it says over 500 iterations, you have negative 10.6 on TLT versus what we saw actually happen from 2020 to 2025 of negative 10.1 here. And then the average return for SHY was 1%, and we had 0.99. So basically, exactly spot on the same, meaning that it looks like that standard deviation number is, whether it's 2% or less than 0.1%, it's very low, and that it's always, no matter what scenario, which 500 iterations happen to occur, it's not moving. It's just right there at 1, no matter what. Okay, so that's kind of what we're thinking. Obviously, if we were to get an interest rate reversal and this TLT return was positive 10 instead of negative 10, obviously that would completely change the performance of the entire portfolio. versus this, you're just going to be locked in at a 1% return. So it is more risky, but it just depends. If you're going to be in it for a long time, what I've been saying is if you only want to run this strategy for 2 years or less, or if you somehow feel like you're a low risk type of person, stick it in the SHY. It's guaranteed 1%, and it's a great way to just dilute an otherwise risky portfolio like this. But if you're in it for the long term, or you'd like to, be a little bit more risky investor, then TLT might be sort of the better risk-free asset for you. Pretty high standard deviation. It's almost as high as it's higher than our modern portfolio risky bucket here in the green, and it's pretty close to the S&P 500's. Standard deviation. So if we keep going, what you basically have to do is you have to find the excess mean annualized returns for each of these, which means you're basically you're taking what you had over here and you're subtracting off the risk-free rate of 4.79. So all we're doing is taking everything we had before, and we get over into this section, it's just everything minus 4.79. That'll give us the new numbers. Then once we get over here, you have to basically apply the weights, meaning that we know that we're going to have 66% in this and 33% in this. So we'll just apply, it's just a multiplication exercise of taking what we found here over in this section to the left in the orange. When we get over to the yellow, we're just multiplying by some number less than 1. So those will all drop, those will all be lower. And then we got to combine with the risky assets. So you're taking the weighted excess mean annualized return, just the things that we've been calculating to the left, and then you need to basically combine with the bond fund that you chose. So this one is TLT, this is SHY, and typically it looks like we're going to be having lower numbers over here with TLT because we know what TLT had a negative 10% return over 5 years, right? Whereas SHY had a positive 1% return. So basically, no surprise, almost every time our numbers when we combine the SHY are going to be higher as far as our returns for each combined asset. Now here I have my plane and I have my big dark cloud and I have my thunderbolt because this is something we're going to have to come back to. I will show you, if you're not familiar with data, you can do on the top there's this thing called the formulas tab. Okay, home, insert, draw, page layout, formulas. And there's this thing here called trace precedents. It's like the things that kind of came before the things that are feeding into this box here. So I wrote that the standard deviation when combining our risky assets, basically that, going back to this orange dot. And so like the green one that I'm using here, like this risky assets, is the same as this orange dot here. Meaning this is like, these are all the risky ones. We know we can get as much of the risk-free asset down here. We get as much of that as we want whenever we want it. It represents a white line. But this basket of like risky assets, these are all the risky assets, and this orange dot here that I talked about before basically corresponds with this. This is what I'm saying, this modern portfolio theory risky assets bucket, right? And we have, for me anyways, 2/3 of our money in this risky asset stuff, this orange dot, and I'm diluting it by putting 1/3 of my money in either TLT or SHY, right? So the same thing we've been talking about. So one thing I need to know is, well, what's my standard deviation for my 2 asset portfolio? Meaning I got 66% in green, I got 33% in TLT. I need to know my standard deviation for that portfolio. And here's where I made a mistake. So I wrote 13.33 initially because, well, I was a little bit lazy, and honestly I wanted to find out like how much difference is there from just like taking just a simple average, this thing plus this thing divided by 2, versus doing some of this work that we'll do over here. I had to do all this extra work to come up and meet with this formula. This is the standard deviation for a portfolio formula, which I'll lead you through. But it turns out that it's pretty significantly different, and it will make an impact. But when I was early on, I said, well, it looks like if I mix the green with the TLT, I'll have a new portfolio standard deviation of 13.3. And those trace back to these boxes right here. So what I basically did is I said I got 2/3 of my money exposed to this thing. So I'll take 2/3 times 12.43, and I'll add it to this thing with the appropriate weight on this. So I'm going to have 33% of my money in TLT. So I'll take 0.33 times the standard deviation of this asset, which was 15.17, and I'll just basically take like a weighted average. And if I do that, I got the 13 point whatever it said over here. I'll follow my lines over. 13.3. Well, it's wrong, okay? And this is wrong, and it's off by a lot. So one thing you should know is definitely don't do that. don't take simple averages of, if you have a portfolio with two assets and you're 50-50 in each. Let's say one portfolio has a 30% standard deviation, the other has 10. You can't just add 10 plus 30, which equals 40, divide that by 2 and say, oh, this portfolio has a 20% standard deviation. It does not work like that. But I did run some numbers with it working like that, and I found something pretty interesting. I came over here, I did my 500 different iterations, and I wanted to know, if I have modern portfolio theory, is the Sharpe ratio with my modern portfolio theory using TLT, is it better than the S&P 500 Sharpe ratio? So you can see I have a Sharpe ratio of S&P 500. I have the Sharpe ratio using my wrong numbers. Thankfully, those are going to improve when we do the calculations correctly. And I had the Sharpe ratio with the SHY when I combined it my modern portfolio theory with SHY. And what I was coming up with was like, we could beat the S&P 500 about 55% of the time. If I use SHY, 55%, and maybe 42% of the time I could beat it if I ran the portfolio with TLT. Yeah, I mean, it should be less. TLT had negative returns. SHY had positive returns. So TLT, like we said before, is going to drag down the portfolio. And I thought, well, shoot. Okay, well, that's kind of interesting. But then I thought, hold on. I should do this the right way. I went to school for this. Let's do this the right way. And what you have to do it the right way is you have to go and find the assets. You have to add them up, and you have to put on the appropriate weights on them. Okay? Then you have to basically get your monthly returns based on the weights that you had. And then what you have to do is you really need a correlation to do this. So I need my combined returns on a monthly basis for my risky assets, okay? And again, like this thing, I need to know what are the basically monthly returns for this portfolio. Maybe I'll just make this green so it's like more logical for everybody to track with me. So we'll make it the same. Is that the same green? I think it's this green. I do like that green, by the way. So we're basically finding the green there, and we need the monthly returns on that, as if I would have bought just the selected assets that the modern portfolio system told me. I need basically monthly returns. And then I need to be able to compare those to the monthly returns of the SHY. And if I have those, I can go into Excel, do data tab, data analysis package, and I can find the correlation. Correlation is what you need. So I need that. My risky assets, how correlated is it with SHY? Same thing. I need to do my risky assets provided by the modern portfolio theory model compared to TLT. And I'll get these two different correlations. They're actually both fairly close to each other, surprisingly, about 0.4. And then you can put it in this equation, which is common undergrad, basic type of stuff. I know it looks a little messy, but what you're basically doing is if you want the standard deviation of a portfolio, you're just going to take the square root of this thing. And it's not that difficult. You're just taking the basically the weight. So I'll just walk you through it on this. This is for SHY. So it's not hard. We'll go through it. We're going to be taking the square root of all these colored boxes, but so it's the weight on the first asset, which is my risky assets, the one that we've been putting in the green. And we're going to square it. We're going to multiply that by so that was the weight squared times the standard deviation of that asset, which I know. Yep. And then we're going to add the weight squared of the second asset. So this time it's the weight on SHY squared times the, standard deviation of SHY squared. And then we're just going to add 2 times all the boxes. And the last box that we needed was the correlation. And when you do that, you'll get a different standard deviation. 0.59, so 5.9% standard deviation. And this other one is 0.897. So we're about a 6% standard deviation or about a 9% standard deviation. Well, that is a lot lower than what I did using the basically arithmetic averages. So what we need to do is, so here you're seeing it used to be 8.3. The correct number is 5.9. So we'll shift that down all the way. And now we have dramatically lower standard deviations, much, much lower than the standard deviation of the S&P 500. S&P 500, you remember, had a over 16 standard deviation. Here we've cut it with TLT almost in half, and we're way under it on the SHY. So that will help our Sharpe ratio dramatically. And here it looks like now we're outperforming 63% of the time, 62% of the time. So something like 61% of the time if we were to use modern portfolio theory and combine it with the SHY for the risk-free asset. And even in a situation where the TLT bond fund has gotten completely beat up, negative 10% return over the last 5 years, we're still beating the S&P 500 by like 41% of the time. So I guess we'll continue to get hurt if the interest rates move up and we stay in the TLT strategy. Hey, so I wanted to highlight that there was a error that I found here when I was doing the prior calculations for this portfolio standard deviation, according to this formula. The standard deviation for the combined should be just like we saw in the beginning, 12.43, and that should be 12.43 in both. And then this is the standard deviation for TLT, 15.17. It's the same as I was talking about in the very left side. So went all the way back to the beginning. It's 12.43, 15.17, and 0.22. So those are the numbers that I used, and I didn't get correct this section. We're seeing that still we're pulling outperformance of the S&P 500 56% of the time if we use modern portfolio theory using SHY as the risk-free. If we're mixing it modern portfolio risky assets with TLT, it's outperforming 44% of the time. Here 56 and 40, 55 and 38, 54 and 40, 54 and 40, 54 and 40, 53 and 37. So we really have like consistent outperformance with modern portfolio theory using SHY. Every single time that I've run a new iteration, it's always beat the S&P 500. This time 62% better. And really, like, the portfolio with TLT, given the underperformance TLT has had, is not usually able to outperform the S&P 500 in this period. But it looks like every time with SHY, it's better to run modern portfolio theory and use SHY that will beat S&P 500 59% of the time here. So it's always beating it, more than half. So it's superior. I'm excited to say it's just superior. So that's good. Okay. Let's go back to the rest of the video, but I did want to highlight that one correction. Essentially, these are the numbers that we ended up with: 11.3 on standard deviation for TLT when combined with the risky assets, or an 8.3 if we use the risky assets combined with SHY. Okay, thanks. But if interest rates move in our favor, meaning that they come down, the returns on TLT will become positive, and we will not only outperform the S&P 500, we will also outperform modern portfolio theory combined with the SHY product. And so that's why it's something for the more risk-taking type of investor. Anyways, what it means is, even though the S&P 500 has had an incredible run. Yeah, so going back here, even though the S&P 500 has had an absolutely incredible run over the last 2 years, 25% return, when on average it usually only does like 13% return, right? And it has a high risk profile, between 16 and 17% standard deviation over the last 5 years. You can actually outperform it with modern portfolio theory, as we've shown that we had. If you play it safe and you go with the SHY, you're beating the S&P 500 on a risk adjusted return 63% of the time, right? Even when the S&P 500 has gone nuts. Now, in part, we've also benefited from that, from some of the assets that we've been able to choose. Some of the risky assets have also gone up in a similar manner to how the S&P 500 has gone up. But I will also say that even just on that basis, we've done better. So if we go back here, just to reiterate, and we look at the Sharpe ratio on the risky assets, modern portfolio is clearly able to pick better risky assets with a Sharpe ratio of 0.86 compared to only 0.5 for the S&P 500. So we are winning definitely by being able to select superior assets using this strategy, but we're also able to really win as well on the lower standard deviation. So SHY was a great example of that. And if in a couple of years, it could be really interesting to see where TLT is. So TLT, in a sense, is really cheap if it returns to like its average 15-year price, 120s, 115, something like that. You can buy it for $85 today. So if we get a reversal on that and rates come down, wow. Now, if rates continue to move up, we will continue to be hurt, but realize we basically stuck very close to our target. We had a 12% target return. We were able to get 10.9, I think it was. So not bad, not bad to be a little bit under the 12% return. And even, on some scenarios, the interesting thing about running 500 different iterations is, even with TLT getting beat up, and the S&P 500 having a heyday, we're still outperforming it 41% of the time. You know what I mean? So that's pretty interesting. I thought that was great. Now, one of the things that my friend that I mentioned earlier in the video, Justin and his wife, they care for people. They want to help the community. They're doing a lot. She has medical background, so they're doing a lot in nursing and chronic disease care and stuff like that, and other things with youth programs. But we've been trying to say, hey, is there anything that we can put together that would be easy for people to use for some kind of investment, asset, wealth creation, something like this. So that's sort of what I put together. He was really thinking, hey, this is, the big boom of AI. And what I found so far, this is probably going to be super outdated in even 6 months. But Gemini 2.5 cannot do these calculations. ChatGPT, so large language models cannot do that. Perhaps if I upgraded to a paid version, they might be able to do that. I'm guessing they might be able to do that. I'm not sure. For most people, I cannot teach them Python. For most people, I want to look into this a little bit more about how to help people evaluate small businesses and maybe not be so completely dependent upon the stock and bond market, mostly because of the things that David Rogers Webb has been arguing. I think he really has something to say about the Uniform Commercial Code, and we have a number of different videos and content on that aspect. At the same time, I can't imagine that most people are going to pull completely out of the bond and equity markets. I think there's a big push to stay in digital assets, whether that's cryptocurrencies, whether that's what we're talking about here with the exchange, anything that's traded on the exchange, where it's digital, where you're exposed to some of these big systemic risks, illiquidity risks, government defaults. A lot of things is sort of like there's a lot of risk exposure. So I just think that that was really interesting. Like I said, this is modern portfolio theory. There are two different ways to look at it as far as how you want to dilute your basket of risky assets. You can do it with SHY, a 1 to 3 year U.S. Treasury bond fund, or you can do it with TLT, which is a long-term U.S. Treasury bond fund. And depending upon the different environments, TLT is going to be a more risky combination to put with your risky assets that we're basically finding for you in our Patreon models. If this were a different environment, I would assume that the portfolio mixed with TLT would be the top dog. No ifs, ands, or buts. But in a time where bonds have gotten sort of beat up, SHY has proved to be better. The big point is SHY, when mixed with modern portfolio theory, has basically crushed the S&P 500. If you were to not mix it with either of these two bond funds and just do straight up all equity max risk, it's still better. The Sharpe ratio is the number you want to look at. And like we just saw, you would have a 15% return instead of a 13.04% return. You'd have a lower standard deviation instead of a higher standard deviation. Your Sharpe ratio would be 0.86 instead of 0.50. So, I mean, it's just clearly better. If you want to chase the 15% return, and if you can stomach a 12.43 standard deviation, then you don't even have to put any money in these risk-free assets. A lot of people want to dilute them with risk-free, but you don't have to, obviously. So thanks for watching. Let me know if you're able to find any way where you can get AI to do all this work for you. It's not impossible work to do in Excel. It's free in Excel, and it's nice and easy, and you can actually double-check the numbers fairly easily yourself. But you can see the number of transformations that you're going to need Excel to do. It's got to be able to pull. Well, first of all, you're going to need some way to either take the course or buy the Excel sheet in order to find the assets that are here in this green one, these risky assets. And then you're going to need an AI program to pull the raw numbers. Then it's going to need to transform it into monthly returns. It's going to have to be able to find, I guess that's all it would really have to do for you. You'd have to give it a list of assets. You'd have to ask it to find the best assets based on the last 5 years, given the, we call it mean variance analysis. Mean is the average return. Mean is another term for average. And the variance is just a slightly different term for standard deviation, or it's a related term, I should say. And so mean variance analysis. If you can punch into ChatGPT in the future or something and say, can you run the mean variance analysis, include all 11 U.S. equity sectors, also include Bitcoin, include gold, include a corporate bond fund that's investment grade, find a corporate bond fund that's junk, and then stick in a couple risk-free assets, TLT and SHY, and ask it for the best weights. If it can do that for you, then basically, I'm out of business, and I mean, all the finance programs are also a little bit in trouble because that's what they basically teach at graduate school when it comes to portfolio management. So I hope you liked it. I hope that helps. I hope you, for a small amount of money, considering, how much you're investing, could look at this as a strategy. We have a full course that can teach you how to do it. You can pick your own assets if you want to put Tesla. I mean, uranium has been doing great. Maybe there's going to be a big copper boom if you believe that, you'd like to know how copper would perform, if it would be selected or not by modern portfolio theory, given its historical performance. So this is really a backward-looking model, It's going to suggest for you the things that has been performing well over the last 5 years. This is not a strategy for somebody that's hoping to buy the bottoms. You know what I mean? Yeah, this is it's a buy and hold strategy. Essentially, you're hoping that these trends will continue over the future 5 years. If you sell these and then you want to go buy something like a more contrarian style, then maybe David Hunter is your guy. David Hunter is a professional. He's all over YouTube, and or you could buy precious metals, or you could do all kinds of stuff. I mean, I wouldn't know what to tell you at that point. Obviously, I cover a lot of information on Moderna, and that's about all I really cover. So there's a million stocks out there. There's a million strategies: momentum, value investing, precious metals, macroeconomic. Those are probably the big ones for the average person at home thinking about buying stuff. But hopefully, come up with a strategy that's better than just buying random just things that you happen to come through your feed on your news feed. You know, just like, oh, Tesla's going to build 6 billion robots. Like, maybe 285 is a good share price. Maybe I'll buy it at 285 because I don't know, it's down 10%. Like, well, I don't know. We'll see how that comment ages. I mean, if they build 6 billion robots, you know. But I don't have any way to gauge essentially that. I don't have Tesla. I could just tell you I don't have Tesla in the specifically in the model that I'm sharing with you here. So if you want to, you know, look at something like that, then this could be helpful for you as far as how to add in a couple strategies, industries, like I said, uranium or Tesla, that would like basically how to build around a strategy. If you want to have a core strategy in a company like that, like 20% exposure to Tesla, and then give me the best complements to go with that, you can do that with modern portfolio theory as well. So, and the reason is because it will look at the basically variation between Tesla and all these other things, and it'll find things that basically work well together. When one is up, the other is like, you know, down. So you have like a more, but together you have positive trends that isn't all over the place. You have a consistent sort of easy upward sloping positive returns all the time, and you're not doing this boom bust anxiety thing. So if you want to do that, you know, go to Six Flags and take your family, buy a $7 soda or something. We'll talk to you next time. Thanks so much. Bye.